Good morning, hello, good evening, good morning, wherever you might be. This is Tchaikovsky, and welcome to Intermediate Accounting Unlisted, meaning that I didn't write the question. It's a Kieso and Weygandt 16th edition exercise 12-14. So this is when we have goodwill impairment. And when we look at some of the companies today and how much acquisitions have been happening, you're more than likely going to be seeing this happen more and more in terms of seeing like, okay, is there in fact a goodwill? Is there in fact an impairment? The first thing right here is we've got, the Carlos division is developing a new aircraft, and if successful, kind of going on, management estimated its future net cash flows from the project to be $400 million. Management has also received an offer to purchase the division for $335 million. And all identifiable assets and liabilities and book and fair value amounts are the same. So let's first kind of talk about this right here. If, as management, when we're looking at goodwill and when we put this on our balance sheet, and again, all these amounts here are in millions, and this is why I've converted it over here. When we have as management, as we put this goodwill on the balance sheet, the thing we have to be really careful about goodwill is that it isn't tangible, but it really represents, if we sold a company, we're really not gonna, you're not gonna necessarily really get anything for it. Rather, this is the amount over the fair value of the assets that we paid for, right? So when we were recording goodwill, and we had an example of this, which I think was exercise 1211 for Warfield, which was essentially, okay, over here, we went and we based, this is from I did this on another YouTube video, and over here, the amount of the goodwill was like 160. It really is a notation to the user that we assigned all the fair value here to all the assets and liabilities, and this was the excess amount that was paid. So when we see goodwill, especially on a balance sheet, if like you're evaluating a company, you got to throw that thing out the window because it's just there. I don't want to call it an overpayment, but that's partially kind of what that is. But it's not to say necessarily something's bad. Facebook has about 18 billion in goodwill, and it's how a lot of companies grow their business is through asset acquisition. So when we're going through and doing this, if we only had the $400 million net cash flow, and typically what you would see is that a company would essentially hire someone to do an appraisal of that business because they kind of want to justify the goodwill. But in this case right here, what's a little bit different is that we actually have a fair value offer. And so essentially right here, what we're going to do is there an impairment, and what we're going to be using is we're going to say, so for goodwill impairment, our test is basically if the net assets are less than the fair value, if our net assets are greater than the fair value, an impairment has occurred. And so right here, we've got 350 million of net assets. The fair value of this is the assets here are 335 million. So the impairment initially right over here is we're saying that there's an impairment, or so that there is in fact an impairment. So that's the first thing we've said. Now, once we've impaired the goodwill, right, and before we go any further, one of the other things we would want to do is we would also need to say to ourselves, is this property, plant, and equipment net? Is this still here? Is this still the true value? So over here, all identifiable assets and book and fair value amounts are the same. So there is an impairment. Now what we need to do is to determine the amount of the impairment is we're going to essentially determine the implied value of goodwill. So our implied value of goodwill is going to be the fair value which is going to be 335 million. And for this fair value here, what we're going to be doing then is we're going to compare this to the carrying amount of the net assets without goodwill. And so if we're looking at this here, so this is our carrying value. This is going to be carrying value without goodwill. So here, so basically the carrying value of our assets here without any type of goodwill is going to be $150 million. So if we put over here, this amount over here, we've got 150. So what this is giving us then is our new implied value of goodwill. Is going to be 335 minus 150, or 185 million. The reason why this step is important is because if the carrying value here, or I should say this is really going to be the book value, and then here the carrying value without goodwill, if say for instance this property, plant, and equipment wasn't worth 2.6 million, rather it was 2.5, you're going to be getting a different amount here for this. So this is giving us our implied value of goodwill. Once we have this implied value of goodwill, what I'm then going to do is I'm going to compare this to the goodwill on my books. So my goodwill that I have presently on the books is going to be here at $200 million. And then my less implied value of 185. And let's just make this a nice color-coded accounting with Bob Ross here. There we go. Beautiful. And this is going to give me my goodwill impairment. Okay, so right over here, my goodwill impairment is going to be $15 million. So once I have this $15 million, what am I going to go through and do with it? Well, immediately I'm going to credit goodwill. And this is going to be on 12/31/17. I'm going to be crediting this over here for 15 million. And my debit is going to essentially be loss on impairment or goodwill. So here, this is going to essentially be to record goodwill impairment. So over here, so again, when I'm doing a goodwill impairment, the first thing I need to kind of, excuse me, the first thing I need to do is to stop smoking 12 packs of menthol cigarettes every day. Or I can just start vaping with the Juul. Now, what do I need to do? I need to first basically say, okay, has an impairment actually occurred? And the way that I know that that impairment has occurred is that the net assets, if they're greater than the fair value, we do have an impairment. So that's my first step. Okay, I'm not subtracting these two, even though I get to that amount. That's what I'm not doing. So that's my first step for goodwill. The next thing I need to do is I then need to determine the implied value of the goodwill. So I'm going to take the fair value, or what somebody offered me for the division, and that's what we're determining to be fair. less the carrying amount of the net assets without goodwill. Notice here, this is what it's on my books for, and this is the carrying value. Very important step, because if property, plant, and equipment is different, then that's going to give me a completely different value. So right over here, this is going to be 150,000, so 150 million. So my implied value of goodwill is 185 million. Now, once I've determined the implied value of goodwill, I compare this with what's actually on the books now, and that tells me the amount of the goodwill impairment. Again, this part here, just kind of think about this in terms of what is exactly fair value. It could be the 400 million if you have an appraisal from a third party to back it up. Or in this case, the 335 million is something where this is going to be a much better, condition here for what we actually call fair value. And again, management would have to go through and make this determination. If this was a lowball offer, then maybe you're going to kind of say, wait a second, the 400 million is a better indication of fair value. So right over here at December 31st, 2018, it's estimated that the division's fair value has increased to 345 million. Once we have an impairment of goodwill, we do not reinstate it. We don't put it back in there again. And this is really where kind of accounting changes over time. When I was back in school, back when there was blackboards and Little House on the Prairie and like covered wagons and gas lamps and other things like that. And and when I graduated in 1891 from UCSB, so it's kind of like when we're looking here at impairment, or basically goodwill, when I was going through, we would amortize it over 40 years, and that is gone by the wayside. And now what they're saying is like, okay, you're going to leave this on your books. Now, I believe what they're going to do is they're going to start giving the companies the option in terms of amortizing it. So yet again, another non-cash item that we're going to have to go through and back out of the financials. However, at the same time, when we really look at goodwill in terms of sitting on the books, it's not necessarily something that, if you're an investor and looking at a set of financial statements, you pretty much should be throwing it out the window anyways, unless you can really kind of prove like what that value is. So that is a kind of a discussion here in terms of goodwill impairment. I want to thank you again here for joining me in Accounting During the Dark or Accounting Fun 101. Have a great night, and please remember to like and subscribe, and I will see you soon. Take care. Bye-bye.